Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, December 14th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Getting ready for the holidays coming up here.
All right. Well, let's start off with looking at what the market's been doing this past week with a look at the market letter.
All right. Well, the volatility keeps coming for the market. Last week we had some stronger than expected economic data, which signals the Federal Reserve may have to stay the course a little bit longer as far as raising rates, and it also raised the prospects of a recession to investors. We saw yields tick higher, and then after the PPI report came out, and stocks, of course, moved lower. As long as the 10-year stays above that 3.5%, it seems that the major averages just kind of spinning their wheels. But anyway, what we saw that we had some wage inflation. We had better than expected factory orders last week. Services data was strong. And that, going into about the middle of the week, kept the S&P 500 on a 5-day losing streak. And then they were able to bounce somewhat on Thursday before that PPI report came out that on hopes that, okay, well, we're going to see inflation crack a little bit here. And we didn't get it. In fact, the core-PPI, which shows the producer price index, showed that wholesale prices rose 0.4% versus 0.2% expected, and that again caused rates to move back up. So we had the 10-year Treasury jumped up to 3.57 to close out the week, and like I said earlier, that 3.5% on the 10-year seems to be a stopping point for the rallies. But so we got above that, and then as we closed out the week, investors got a little bit more nervous. They were, they turned their sights on the CPI report that came out today, and also tomorrow, conclusion for the FOMC meeting. We get the Fed Chair Powell's press conference at 2:30 tomorrow. So that's going to be another volatile session tomorrow, and we'll see how we roll with that. Let's see, the market just, here we go. Weakness in equities was pretty much across the board last week. Every sector was lower. Energy was the worst performing group. It was down almost 8.5%. Crude oil prices hit a new low for the year. A lot of that was on uncertainty over China's reopening. And then, of course, the recession fears in the U.S. and Europe would create less demand on that. Crude ended the period at $71.47, but it briefly got down to $70.19. So that was down about 11% for the week. Selling oil-related stocks also, weighed on the market. Some of those are, big cap type of issues like the Chevron, Exxon, that type of stuff. Growth sectors, communication services, consumer discretionary, financial materials, technology, they were the main contributors to the sell-off besides energy. And as we got into the weekend, we saw the Dow down about 2.8%. The NASDAQ was down 4%. And let's see, the Russell 2000 was down about 5%. They're about 4.25%. Now that we saw deterioration across the board and in the major averages. A lot of that was that we'd seen the week before some of the major averages come up and take out some resistance levels of key moving average levels, and some of them were the 100-day moving average, some the 200-day, and all of them kind of broke below that except for the Dow. It's outperforming, of course, but a lot of them gave up that resistance level or that which would have been support level then, and as they were going lower. Different indicators for the weekend, we saw the MACD, which gauges kind of the short-term trend. It crossed into bearish territory for the different indexes. And momentum, as measured by the 14-day RSI, kind of slipped back into neutral ground for the different indexes. And you can see that it's slowing, meaning that we just don't have much oomph behind the rallies as we would expect. And in fact, I think we talked a little bit about the negative divergences that we were seeing in some of the indexes. A negative divergence is when you see the indexes start to make a new high. And this is also true in stocks. Yet when you look at the 14-day RSI, they're making that high without the positive momentum that you would want. In other words, it's kind of the stragglers are sending it up. People late to the party are sending it up while a lot of the people that are already in the stock are beginning to take profits in that. So that's why we call it negative divergence, because it's getting there with not on new buy and any of that type of thing. Okay, the Dow Jones, like I said, continues to outperform. It remains above its 200-day moving average. It's also above its descending trend line, which was a big thing for this thing to get over. The other indexes pretty much have stalled, like I said, right around some of these resistance levels, and it broke support. The S&P 500, after it rallied off the October low, it stalled below its descending trend line, which if it can break a long-term trend line, generally it leads to a longer-term shift in the from bearish to bullish. But it just can't quite crack through that yet. It also was unable to hold support at its 200-day moving average, but it did find secondary support at 39.30, which is a 100-day moving average for the S&P 500. So that was something that traders are going to watch that. Now, I said in Friday's letter that if we're going to get a year-end rally, we'd like to see see that 39.30 hold. If it can hold, maybe we'll get a bounce off of that, which we got a little bit of. If it broke, however, you could see the S&P 500 trade down to about 38.40, which would be probably about another 1,000 points or so for the Dow. Now, the NASDAQ failed to penetrate resistance at its 100-day moving average. It came up, got close to it, but as it backed off, it did hold support at 10,924, which is the 50-day moving average for the NASDAQ. And if you look at the chart, it's been pretty range bound for the last couple of weeks. So that's something we want to see. It kind of has a little bit of a coiled spring look to it, which you usually a lot of times that will, as I said a couple of weeks ago, that when the S&P 500 looked like it was a coiled spring, but underlying breadth led me to believe it was going to break higher, which we got. In this case, last week the underlying breadth wasn't that bullish, and it made me that's why we're a little bit suspect of what we're going to be doing this week. We want to see what happens here. Secondary indexes were showing negative divergence. By that I mean when you look at the Russell 2000, the small cap index of transports, you'd like to see those two and maybe even the semiconductors lead the market higher or lower if you're looking to see what's going on. And both of those indexes were down more than 5% last week. So they're underperforming the broader market. They're under distribution. Both the transports and the Russell 2000 were unable to hold their respective 200-day moving average. That's a negative going forward. But the transports were able to find support at its 100-day moving average, and their Russell broke below that. It closed near its 50-day moving average. So they're coming in and kind of stopping any sell-off at secondary support levels, which is good. It means that since we're down here at a bottom, you want to see some of these support levels hold. You don't want to just see a free fall every time the market because of some bad news. So the fact that we were holding this made you kind of believe, well, we can probably get a bounce if we get some positive numbers this week. The underlying breadth was weak last week. NYC and NASDAQ AD lines both lost 4,000 to 5,000 units. And that's a lot. That was pretty much distribution across the board. Like I said, that's another thing that you want to keep an eye on. I think, in fact, I said something about the NYSE. Its AD line now has moved. It hasn't really made much ground since October. After we made that bottom, we had a little bit of a tick up. Went from like 498 up to 506, and now it's back down to about 501, 502, something like that. So it's not really showing you that there's a lot of accumulation going on underneath the market moves here lately. As far as sentiment goes, again, that's a little bit mixed. We have retail investors; they're firmly planted in the bear camp. The American Association of Individual Investors has the percentage of bulls down to something like 28%. Historically, they're up around 37%, and they just cannot. We're just not seeing much on the retail investor. I guess they're pretty beat up at this stage, and they don't want to really jump into something if they jumped in April or jumped back in August, they've gotten pretty beat up. But the AAI showed the bulls were 24.7%, and the bears were 41.8%. That's you usually don't see it that high. Now, as far as the active investment managers go, we did see their exposure to equities pull back a little bit. They were down to about 55.7%. They were just 65% exposure to equities 3 weeks ago. So that's something we want to watch. And I also mentioned last week something that bothered me, and that's the Refinitiv Lipper U.S. fund flows. They reported equity outflows of $24.9 billion for the week ending 12/7, and that's the fourth week out of outflows over the last 5. And generally in December, if you start getting retirement plan contributions, you start getting bonuses, that type of thing, you're going to normally see the fund flow show positive influx of funds. Now, 20 and 21, it was kind of mixed up for obvious reasons. A lot of it, with the COVID deal and all. Then last year, we just started to get hints that we may be topping out in the market. So, but the fact that you're having this much, you're not seeing any inflow is somewhat bothersome. Now, part of that also, I think, is that you may be getting some funds into some fixed income areas. For the first time in, I don't know, 8 years, 10 years, people are finally able to put some money into bonds and put some safe money away and get themselves 4 or 5%. And that's probably going to influence people that have been, especially retirees that have been hurt over the last couple of years. So, anyway, I ended up with the letter last week. December's off to a chilly start, but we had some stuff coming up this week that could give us a little bit more of a picture of whether we're going to get a year-end rally or not. Now, today was kind of a big deal here. We had on my notes right here, the CPI came in better than expected. We came in at let me see what I have here in my notes. It came in at 7.1% year over year. They were looking for, I think, 7.2 or 7.3. That's down from 7.9, I believe, last month. Core CPI rose 0.2% versus 0.3% estimated, and that was 6% year over year versus 6.1% consensus. And the Dow rallied 707 points on that news. Across the board, everything was flying. Growth sectors flying. Everybody was in there. I think a lot of that also was short covering rally, because the shorts thought, well, okay, here we go. We're going to get, I'm going to get stuck here. And then the crazy thing about it, we sold all the way off. The Dow was down about 60 points going right around noon. Then I saw it jump. It was up about 180 points here around 1 o'clock. And now I think last I just looked, let's see where we're at right now. Okay, going into the last hour. Now going into the last hour, the Dow's only up 60 points. I did notice on this morning when we had this rally, we saw the Nasdaq, S&P 500, and Russell 2000. They all jumped back above those key moving average levels that we want to see them be above, and none of them were able to hold it. They all came apart. So that's something to keep our eye on. Tomorrow, this is kind of a big deal. We keep getting these conflicting signals that I'm watching. Now the Dow Jones is only up 16 going into the last hour. Now, tomorrow we get the FOMC meeting announcement, and I think that people, they're going to have to be, they're hoping that Powell's going to come out here after the CPI report and say, okay, and our rate hikes are working. What we want to do, we're going to back off a little bit. We're going to slow the amount of rate hikes going forward. But his problem is he doesn't want to sound too optimistic about how things are. If he comes out here and is too dovish, he can see the market also take off 1,000, 2,000 points. That's going to ease financial conditions, which the Federal Reserve doesn't want. They'd like to keep money tight here going forward a little bit, and that may disappoint investors when he gives his press conference. Now, as of right now, we still about an 80% chance of a half-point rate hike tomorrow. I'm in that camp. I think that's what the market's expecting. I don't think that's going to be much of a mover. But then, as far as February 1st, this is a little bit of a change, and this I think the market likes. We now have only about there's about a 53% chance of a quarter point hike at the February 1st FOMC meeting, and that's up from 35% just a week ago. And as far as a half percent or half point move on February 1st, that fell down to 40% from 50% a week ago. So that's something to look at. And then we're back down to about a 47% chance of only a quarter point hike in March. So again, market participants are really looking to try to, they want to see the Fed slow down. But the Fed still has a lot of work to do. I mean, no matter how you look at it, 7% inflation is not, even though it's coming down, it's still a long ways from where they need to be. And I think that Powell needs to emphasize that, and he will emphasize that just to keep people from getting too excited. Last night's daily comment, if you read that, I talked about Morgan Stanley, what they had to say. They thought there was probably about a 50% probability that the CPI would come in around 7.2 to 7.4, and if we saw that, we could get a 2 or 3% jump in equities. And we came in at 7.1. I think we saw the Nasdaq this morning was up about 3.5%. So I was surprised. They were pretty strong on that. And they also said you could possibly see the S&P 500 soar up to 5% if it came down at 7%. So we didn't quite get that bounce. They may be a little bit surprised at how unsticky the gains were. We'll have to see. I mean, today's breadth is strong. Volume, it's good. It's not great. But, pretty much across the board, we are seeing, almost every sector has some gains. But we are, like I say, the Dow's negative as I'm talking right now at 3 o'clock. So we'll have to see, how we finish. I think, again, tomorrow is another volatile day, and we'll have to see what, how Powell handles his announcement.
All right, so stocks have rallied this week with the Dow Jones jumping 1.58% yesterday, and then again trading sharply higher this morning after the release of the November CPI. Is the year-end rally underway?
Well, it's hard to say it's not. Although we're still below where we were last week. I mean, you look at. Okay, we finished. We started the month at 34,589 on the Dow. That was on November 30th, and right now we're at 33,9. So we're still down about 600 points. And that's with 2 days of rallies in here. So I think the thing that the committee's still mixed on this. I get conflicting signals. I keep seeing some negative divergences in some of the different indexes. Again, Powell could come out tomorrow, and if he hits on all cylinders, we could see the market up 1,000 points. But I don't think he wants to see that. I would be surprised if we do jump to that. I don't think he wants to kill the market either. So, I can see us at least spinning the wheels a little bit here, probably. At 3 o'clock, we probably, or 2 o'clock when the announcement gets made, we probably see a spike in stocks, and then the C-Talks, we'll probably see see the market give back some of those gains. That seems to be what we've done the last 1 or 2 times. And you get the initial pop, and then it kind of it fades out a little bit. But if he just gives the market a little bit what they want to hear, and that's that we are making progress, but it is a work in progress, and he can possibly hold on to these gains, then we can start to see the market maybe move a little bit higher towards the end of the year. Now, the real Santa Claus rally historically is actually the only it's like the last 3 days of December, I think, and then first 2 trading days of January. So we've got a little bit of time for this to work out. Again, what we don't want to see is the market go down 300 or 400 points. Again, right now the S&P 500 is holding 4,000. This is 4,000 as we speak. That would be a plus for the market for that. As far as the major averages go, let me see here. Let me put this up real quick. Okay, the S&P 500 as we speak it's back below the 200-day moving average. The NASDAQ. The NASDAQ wasn't able to hold the 100-day moving average. It's back below that. The Russell 2000 initially traded back above its 200-day moving average. It fell below it. And let me check the transports. It probably faded too. Yeah. Well, actually, the transports are doing a little bit better. They broke above the 200-day moving average yesterday. They had a big day yesterday with FedEx and UPS, and a lot of the airlines were way up. It actually had a nice rally to start, and right now it's sitting on the 200-day moving average. So we'll see if it holds that. That's somewhere around 14,126 is the 200-day moving average. So if you see the transports below 14,125, that would probably be a negative for the broader market. So I think it's still too early to say that we're in the throes of a year-end rally yet. I said yesterday it was probably contingent on the CPI, and we are higher for these 2 days. But let's see if we can hold on to some of these gains, and we'll give Chairman Powell a little bit of room tomorrow to see what he can do for the equity market.
All right. Well,
yeah.
If you're go ahead.
Well, I was going to say, do you have any other questions? I know somebody had sent in an email. They wanted me to talk about John Deere briefly.
Yeah, if you're still mixed on whether we're gonna be going up or down, what are some of the tools or features on MarketEdge where we can look and help get a list ready for when it goes down or up?
That's a good question because, like I say, when you have something like this where you're hoping for the best, but it's to make a nice run, you want to find some stocks that are getting ready to break out, but there's always a chance that it may not break out. It may go the opposite way that we're hoping. Go ahead and click on advanced tools up there at the top. Okay. And advanced tools, there's a couple of things here with trading ideas, but one of my favorites to look at is point and figure charts. Because what this is stocks that have reached a level that basically what happens is it goes at a level that hit this point before resistance or support, but they've just now broken through them. Let's take a look at the point and figure top breakouts. Okay, now this gives you a list. What I usually do is I take the power rating and click on that so I get the ones with the highest power rating towards the top. Now the first couple normally it'll be a breakout and the power rating is like 90 or 100 or something like that. A lot of times that's something that may have gotten bought out or something like that, so you can ignore those. But if you go over to the symbol list, you can see some of these. That's the first one, Horizon. You can see, I think somebody was buying them out. I forget, Merck or somebody, Pfizer. But you can see how that is soared up there. Let's go down here. Here's a couple stocks that you can look at. Here's KLA 10 Core Corporation. You can see over there it's had a nice run off of the October low. Now it's kind of slowed. It's starting to still inch higher. LGIH, that's one of the housing stocks that's a little bit lower priced houses. This is a chart that's, once we bounced, it came up in August and it came back down in October, kind of found the same support level. And now we're up here trying to get above the 200-day moving average. And if it trades at, let's see, what broke out at, let's see, where's the breakout price? We don't have that. Somewhere on there, we used to provide what the breakout price was. But you can go down this list. Adobe has an interesting chart here. It had a big sell-off. You can see now where it gets up to that one level and it kind of bounces off of that. If we get a double top breakout through there, that would be a big plus for the stock. Here's a triple top down here at ConMed Corporation, CNND. It broke out of a triple top. That's the one you can look at. It's a $95 stock, was up here before and a couple $100. So if you make a list of these and put in a stock watch list, you can have a list of these and you can go and see if any of these things are, a lot of them are long already, but these would be a list of stocks that are breaking out. They've got a nice looking chart. They've already sold off, and you can be ready to buy some of these. And another tip to this, if you go down the list, a lot of times you'll see, not in this case, but I think we will if it goes to sales, you'll see a couple of the same stocks in the same industry group. And that's a real signal that not only is this stock breaking out to the upside or downside, but it looks like the whole sector or industry group is breaking out. Click on the bottom breakouts, Will. And let's hit that power rating again. Okay, now these are stocks that broke out yesterday to the downside. They didn't participate. You have Tesla in here. You look at that chart, it's just making new lows, that type of thing. But here's Amgen. Look at Amgen. It's rated long, but it broke through a triple bottom. Okay, Amgen today's down like $3 or $4 after it broke down yesterday. But you can find some different, like I say, some different stocks in the same thing. Now, somebody talked about John Deere. John Deere broke out of a double bottom breakout yesterday. What I wanted to tell the gentleman who wanted me to look at that, John Deere has had a hell of a run up here. It's up, breaking up here the new highs for the year. But you see that gap in the chart. It doesn't show on this chart. But if you look at that chart, what I think John Deere will probably do, if it breaks below somewhere around 430, if you see it trade down to that, it's probably going to fill that gap that you'll see there from around November 21st, something like that. And that means the stock probably comes down to around 415, especially if the market begins to weaken. Because a lot of times when you see a stock with a gap in the chart like that, especially after it's had 1, 2, 3, 4, 5, 6, 7, 8, 9, it's had about 15 days where it's trying to hold that after it had the gap. But it can't break out to the upside, but so far it's been able to hold the gap. But something's going to happen there, one of the two. So if you see it trade to the 430, you're probably going down to about 410 on that stock. But if you're long the stock, I would hold it, through that time period. Because if the market, let's say tomorrow we get another one of these big bumps from the Fed meeting, then you might get this thing breaking out where it could get a nice trade up to about 460. So I would watch that. Now another thing on that point and figure chart that I want you to look at, and this is actually one of my favorite things on the whole site. Go to the point and figure early alerts, and let's look at the early alert buy signals. Okay, again, this is something you look. Now this is a list of stocks, and just take this whole list and put them in your stock watch list. And these are stocks that are going to break out. They're in the process of forming a bullish breakout pattern. We give you the formation. And not only that, okay, most of these first ones we're looking at are double tops. We'll tell you what price the stock's going to break out at. Okay, so let's say, let me take something that's not so big. Here's Boeing. Boeing closed yesterday at 186.27. If it trades at 190, this stock's going to is breaking out of a double top. that may be another price that you want to break out or you want to buy the stock at, because it's got it up there before and it hit it and couldn't do it. Now, when I talked about some of the some of the different sectors or industry groups you might look at here. Okay, if you look at this, of course, there's 5-6 pages of stocks on this thing, but there's also quite a few semiconductor stocks on here. I think ASML, that's one. Then you have Lattice Semiconductor, you have Ultra Clean Holdings, and that's one. And you go down here, so that's kind of telling you that there's some underlying strength in the semiconductors. If you go up to the point and figure early alerts on the sell side, okay, if we start to see if we start to see the market roll over tomorrow, some stocks that might start going down, these would be some stocks that you could look at. Here's Tyson Foods. It's been trading sideways, been kind of bouncing along the bottom. This might be one that if it trades at 62, it's breaking support there. It's probably going down lower. But also here you see Murphy USA. Remember you look at that chart, MUSA. Okay, it's had a nice run up with the oil-related stocks. But if it trades down here at 282, which is just a little bit more of still has some ways to go. We've downgraded it to a neutral. The power range of -1. That would be one in the oil sector or the energy sector that you may want to look at if you own it. Thinking about maybe putting some protection on for yourself, or if the market starts to roll over and they start talking more recession fears and energy and the whole energy group's going down, that would be probably one that you can get a nice trade to the downside on. I don't see too many more in there. Normally there's more of this. I was expecting to see more oil-related stocks like we saw yesterday. But again, you take this look and you put it in a stock watch list, take some of the regular point and figure breakouts from the sell side, and then that way you can come in here and when we see whether this market's going to break to the higher or lower, you can find your good idea list out of your stock watch list. It's just you find stocks that they're breaking down lower or they're breaking out higher, and you can make a quick decision that way rather than waiting for something the market to move and then trying to find your idea. So I hope that gives you a couple ideas. Just if you haven't used that module, it's one of my favorites. And again, with the point and figure early alerts, there's a lot of point and figure traders out there. You're actually front running that group because you know where you want to put your ticket. You can buy, say, this India fund. It's trading at 15.50 close yesterday. If it trades at 15, it's breaking out of a double bottom pattern. You can put your sell ticket in there, or your short ticket, and you're ahead of all these guys. Your order goes in before these guys that are waiting for it to actually break out. If it doesn't go down to 15, you did nothing. Your order doesn't get caught.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.